Good morning. I have with me Ashwini Agarwal, who has more than 28 years of experience in the Indian equity markets. In this conversation, he has been extremely forthcoming about his investment process and given several examples of companies which I think will be very interesting to anyone interested in investing in the markets. It is therefore very important to emphasize that none of this is to be taken as a recommendation to buy or sell. Please read the important disclaimer below. Also, before we start, please pause the video and take time to subscribe to this channel and press the bell icon. I promise that there will be several more interesting conversations in the coming weeks. Okay. So, welcome to my show, Ashwini.
Thank you
I
for that.
have with me, Ashwini Agarwal, who's been in this financial services industry for more than 25 years, I think. He started off as a buy-side research analyst in SBI Mutual Fund, and from a buy-side research analyst to setting up research in SSKI at a time research was an unknown thing, to actually becoming the salesperson in UBS Securities in US, to coming back to India to head institutional equities in Kotak Securities, to getting back to UBS as the head of equities in UBS itself, and then finally coming back to the buy side in 2006. Ashwini has seen it all. He has indeed actually a stellar record as a fund manager from 2006 to 2016. He has actually delivered a 10% US dollar CAGR return across this period, while the benchmark itself has been probably giving a low single digit kind of dollar return in that period of time. And this is an incredible performance. So from 2006, he has actually, along with his partner, set up a category 3 AIF and manages around 200 crores of assets under management today. Welcome again, Ashwini, to this show.
Thank you. Thank you, Mahesh, so much for having me here. Just a small correction, a Cat 3 AIF started up in April 2017. So between 2006 and 2016, we were running an offshore India small cap oriented strategy, which was just too niche and hard to scale up despite the track record. So we closed it down towards the end of December 2016.
Okay.
But the same track record and the same process is what we started the
Cat 3 AIF.
Yes.
Yeah. Yeah, that is actually an interesting time when you started, but we'll come to that. But after starting, on the buy side with SBI Mutual Fund, you took a really circuitous route to come back to the buy side 10, 12 years later. So how did that happen?
So, Mahesh, it's a very interesting story. I was always interested in investing. I used to, I would say in hindsight, punt when I was in college in Shriram in Delhi. And I wanted to be in the stock market. So when I was graduating from IIM Bangalore, there were only two firms that did investing professionally. One was UTI and the other was SBI Fund. And I had an opportunity to work with SBI Mutual Fund, so I jumped at it. Unfortunately, the exit from SBI Mutual Fund was a very weird one. What happened was that I was getting married in 1994. And under SBI rules, they couldn't offer me an accommodation. My wife used to work, or my fiance used to work with Johnson & Johnson, and even they wouldn't give an accommodation. And between the two of us, we used to make a salary of about, if I remember the number right, about 10,000 rupees. And a BHK in Andheri back then would cost 5,000 rupees. So we said, ki 5,000 rupees we can manage, but everybody wanted 11 months rent in advance, and we didn't have that 60, 70,000 rupees. So we didn't want to ask our parents, and I asked SBI, and my fiance asked Johnson & Johnson, but nothing was moving. And at the same time, this SSK opportunity came along, which obviously offered a little bit better pay, and more importantly, offered to take care of this deposit bit on the apartment that we had to rent. So that's how the journey to SSI started. And to be fair, it was a very exciting time because formal research was just coming up. We didn't have the kind of research that we see today, and Shripal and the people he had hired around him, some of my very close friends even today, people like Vikas Saraf, etc., were already there and they were doing a stellar job. So, it was very exciting to be a part of a young team that was trying to do things differently and trying to break new ground in that sense. So it was all a lot of fun. And frankly, research was actually very good because it was similar to what SBI Mutual Fund
Yes.
was.
Yeah.
You were coming up with ideas, you were doing numbers, you were doing, fundamental research, visiting companies and so on. So for the only thing that one wasn't doing was doing portfolio construction and portfolio analytics. So that was the piece that was missing. But otherwise, research was, very similar to
Yeah.
what I was doing at
Yes.
SBI Fund. The journey to UBS and Kotak and back to UBS was a bit of a detour, as it were. So my wife got posted in the US for a couple of years, and I said, "Chalo, apne bhi chalte hain." And UBS at that point was looking for a salesperson to do India out of New York, and that's how I ended up there. 2 years later, we both decided to come back for personal reasons. And Kotak had an opening, and I very much enjoyed those 4 years. Took I would say, a small business to a decent size. It
Correct.
still is probably one of my most exhilarating periods of my career, building up that business.
Okay.
I went back to UBS because it's very weird in hindsight, and with some maturity, one realizes I actually was sick of the sell side. I wasn't sick of the job. I was sick of I wasn't sick of Kotak as a firm. I was just sick of the sell side. But this opportunity at UBS, and they'd been pursuing me for a while. So I just felt that I might feel better if I change the jobs. And, I soon realized the moment I moved to UBS that it was a big mistake because I was doing the same thing.
Yes. Yeah.
And then, of course, you have to bide your time till an opportunity comes along. But mercifully, it did. And that's how I moved to Ashmore in the middle of 2006. Coming to your question, I mean, that did teach me a lot. It taught me how to work with people. It taught me how to build teams. It taught me how to work in large organizations. It taught me how to be patient when chips are down. Um, More importantly, it's just taught me how to. I believe most sell side people are very nice human beings because they get beaten up so much. People left. So I think it's been a wonderful experience, and to look at portfolio management from the outside also teaches you how not to be married to your views, how to be cognizant of the signals that market gives to you. Sometimes they're contrary to your investment thesis, and sometimes you have to listen, and sometimes you have to ignore them. And how do you strike that balance? So those things probably are better learned as an observer, because you can learn that lesson without having to pay the tuition fees.
Correct.
So some of those things are very interesting in retrospect.
Okay. So, let's come to that track record of yours, which is
Yeah.
very important, I think. A 10% dollar-based CAGR return from 2006 to say end of 2016, mid 2017, is a very, very strong return, right? I mean, it's a very good performance, and let's not mince words. It was terrific. So, uh, what was the core invest? There must have been a core. This kind of return doesn't happen just by luck. I mean, luck plays a role, but I think a core investment philosophy is the key driver for such kind of returns.
Yeah.
And what was that philosophy that you really had for your investment process?
So, I've always had a value bias as an investor. I've been a value investor pretty much all my life, and I've thoroughly enjoyed investing. And over a period of time, I realized that the best investments you can make are if you buy a really good business very early in its discovery cycle, because it may not be known to the market, it may be too small for the market to pay attention to it. And if you chance upon it, then you grab the opportunity with both hands and you sit. So that's one. And the second is that when a well-run business with the attributes of being a good sustainable business in the long run is going through a tough time. It's going through a really horrible cycle. It could be because they are going through a very large capex and the balance sheet looks stretched temporarily. It could be because there's a change of leadership. It could be because of some legal issues that they are facing. It could be a whole host of things. And I learned this lesson very early on with ITC. Okay, if you recall, in a very early in our investing careers, 93, 94, there was this
Correct.
big excise duty
Case. Yeah.
that ITC had with the government of India.
Correct.
And at some point, I think in 96, if I remember right, ITC simply paid that, sum of 600 or 1200 crores of, there's some such number.
Yeah.
It's a very large number in the context of those times. Today, 600 crore fine or 1000 crore fine.
Sounds small. Yeah.
Sounds small, but back in the day, it was mind-numbing the kind of money they agreed to pay. And the stock did spectacularly after that. Of course, now there is tobacco and, social angle to tobacco and so on and so forth. But back then, those issues were not there. And, if you bought ITC when it was in the middle of its troubles, you made out like a bandit. Okay, fundamentally, it was a great business. It was, a market leader by a long shot, very positive cash flows, and so on and so forth. I mean, you know what ITC was about. So, when you buy a business which is going through a problem, but fundamentally it's a good business, and that problem looks like going away, or the problem goes away, just don't miss that. And I think, we had some of those, successes in the portfolio that we had over that period, which did extremely well for us. I mean, I can walk you through some stories. I mean, two in particular.
Yeah, very interesting. Yeah.
One was Page Industries. Okay, I mean, the record says it, so I don't have to say it. You can go back and look up the shareholding history of Page Industries, and our fund back then in 2008 used to own 3% of the company. There were only two institutional shareholders in the company at that point in time. One was HDFC, Prashant Jain, and the other was me. Nobody else owned the company. So it had, or nobody else, at least that I recall, that owned the company back in 2008. It was very illiquid. The company had just concluded an IPO early 2008 or late 2007, something like that. The issue was trading about 10% below stock price. Now, the stock was trading 10% below the issue price. And, I looked at it, I spoke to them. It looked like a very interesting business. Then I tried to look up the peers. Back then there were a couple of companies that were listed, which had done horribly over the years. Hosiery was looked down upon. Textiles as a general business was looked down upon. There were all the bad attributes like too much capex and no ROC and no free cash. And this company had all the good attributes. And the only question was that, is the jockey franchise something that they will lose over a period of time? Because, it was, I think, if I remember right, they had it for a period of 10 years at that point in time and extendable. So then we did a lot of work on Jockey International, which is a privately held company, but they have relationships like this in several parts of the world. And all these relationships have survived for 30, 40 years. The Genumals themselves had this relationship for many, many years in Philippines. So we said, yeah, bahut acha lagta hai, isko lete hain. And we bought it. And it took time to buy it because you bought it like 100 shares, 1000 shares at a time.
Liquid, yeah.
So it was very liquid at that point. I mean, nobody was interested because hosiery had never made anybody any.
Correct.
And we did very well with that. So that's one example, being very early in evolution of the stock. The second one was Balkrishna Industries, which we bought pretty much at the peak of the 2008 crisis.
Okay.
So 2008 global financial crisis wasn't a crisis for India because the economy went through the crisis in a very good shape. You didn't have much fiscal deficit. You had a strong reserve position. Growth had been very, very good for multiple years going into the global financial crisis. And on the face of it, there was no, issue with the banks, which had been cleaned up, 5 years before, and the banks were doing well. The financial system was robust. Everything was fine. There was only one problem. A bunch of companies had raised foreign currency convertible bonds in 2006 and 2007.
Correct.
And this was the typical, greed trade, so to speak, on behalf of the companies, because they wanted to issue equity, and they wanted to issue equity at a premium, and the only way to do was to, you raise an FCCB, and the FCCB was convertible, a couple of years down the line.
Correct.
The companies felt that they would get a massive premium over the stock price. And lo and behold, global financial crisis came, your rupee tanked, and suddenly all these FCCB conversion prices were, multiples of what
The actual
stock
prices.
price
Yeah.
were.
Yeah.
And these things started falling due, and then nobody had the money. So, one company, Balkrishna Industries, I still remember, had some $15 or $20 million, some such small number
Small
of
number.
fees due. So, we made a few phone calls, and the stock was getting hammered out of shape. It was the nominal stock price was 125 rupees, I still remember. And I remember rolling up and meeting Mr. Arvind Podar and said, Podarji, bataye. So he said, Ki, yaar, I have the money, I'll repay. It's not a big deal.
Correct.
What our plans are, this is what it looks like. Yeah, we raise this FCCB, and, it will fall due and we'll repay it. It's not a big deal. And Mahesh, the stock has done splits after that, right?
Correct.
So
Correct.
in today's world, it was 25 rupees.
Yes. Look at it. Yeah.
Okay. And we said, yeah, this is just too attractive. Let's buy it. And we kept buying it. And because there were sellers out there who were
In that period. Yeah.
kind of scared about this whole FCCB issue, and there were, other issues, we were able to buy a very decent position, and the stock became a multi-bagger for us. So, two lessons: being early, and then, buying a good business going through a problem. I
Correct.
mean, these two, I think, are the cornerstones of my investment philosophy even today. You have to be either early, or you have to buy a really, really good business, going through a crisis, but a crisis which is not so big that will break the company. A
Correct.
crisis that's fixable.
Yeah.
And it's very important that you, as an investor, should have confidence that the crisis can be resolved. Um, I mean, either it should be, some financial issue which can blow over. You can help resolve it by providing equity. There are a lot of things, but you have to have the confidence. Hope cannot be a strategy.
Correct. Correct. Hope can't be. That's a good line. Hope can't be a strategy. Yeah. So let me take you back in time, because you started your career interestingly during this night. I think 1993, was it 1993?
92.
92. So
92, the market was shut.
yeah.
Started.
So which makes it even worse, because it means that you started in 92, and for the next 9 years you have seen almost a bear market to a sideways market, let's say that,
Correct.
right? Except for that brief period when one sector, which was the IT sector, did extremely well. The rest of the market really didn't do too well till around April 2003, which was the bottom, and from where the 2003 to 2007 kind of bull market started. But 9 years in the beginning of your career, how did that shape you as a person, maybe, or your investment philosophy? Did that actually impact your philosophy? Did it shape you, give you lessons that you can think of today also?
Yes, very much. So again, going to, being early and holding on. Okay. I still remember the IPO of HDFC Bank came at some 20 rupees. It was a 10 rupee premium.
Yeah.
One of the first issuances up in the post CCI world, which came at a premium.
Yes.
And it immediately opened at some 26, 27 rupees. And I wrote a research note on it at around 30 rupees. And I still remember that I put a hold on it because it was unvalued. And, it was a big learning. It was a big learning because over the years, as I saw HDFC Bank evolve and do really well, I realized that, sometimes some businesses are just in that position where they can continue to grow for a long, long time to come. And being too cute about the valuations at the starting point of such long growth businesses is probably the wrong approach. And, we weren't sophisticated back then. Like, we didn't do a lot of cost of equity versus, return on equity type of matrices. What can be the longevity of the business? Can we capture it accurately via DCF? That time you didn't do a lot of that. I mean, it was more basic: price to earnings, price to book,
Correct.
return on equity.
Correct.
What is the 2 years earnings growth outlook? At that time, we were all wondering that it's going to cost them a lot of money to roll out a branch network. It's going to take a long time to get to any respectable size. One also probably under-imagined the role of technology, which HDFC Bank was very early to cotton on to. So I think one of the most important lessons I learned was that um, in a world that's changing and where there will always be challengers and there will be incumbents, and the challenger has something unique, pay attention. Don't let it pass you by just because it's expensive. And I'm saying that as a value investor.
Correct. Yeah, that's what I'm hearing actually. As a value investor, you are saying this, that valuation doesn't matter, especially in these kind of
businesses. It's an exception.
Yeah.
But that's the point that I'm trying to make. Value is not just about low PEs and low price to books. Value is about franchise.
Yes.
Value is about the present value of a long-term stream of cash flows as well. That is also value.
Correct.
Okay. So we shouldn't get boxed in, buying low PE and low price to book stocks, because a lot of that is just crap. It never do well.
Correct.
Okay? I mean, if you look back and see who the members of the Sensex were, in the early phase of our career, and members of Sensex today, a lot of the companies didn't exist.
Correct.
You could have never imagined some of the companies that have emerged from being tiny, almost startup type companies back in the day, being as large as they are today, whether it's services, whether it's technology companies, pharmaceuticals, and so on and so forth. So I think one of the lessons I learned is that you have to look for qualities in a business which are unique, which will make them survive. I mean, why does the business exist? At that time, a lot of the businesses were coming out of an era of license Raj, and they still had uh, competitive advantages which were a legacy of the license Raj. They're horribly run businesses. Okay, they were not competitive at what they did. They were just they had monopoly rights to sell whatever they were producing at whatever prices they wished. And that narrative changed, which is why the market didn't do anything. If you remember the number of companies that blew up in that decade, was phenomenal. Right? And why did that happen? That happened because they just didn't have a business model.
Correct. Their business model was flawed. Right?
The business model was flawed. You were essentially a rent-seeking monopoly in many cases. Okay, so that was the other lesson, that if there is a business which is doing well purely because it has some sort of a duty protection, or it has some sort of a government support, or some other uniqueness which is bound to go away as the market opens up or as consumers become wiser. I mean, don't be in those businesses. That was the second part. The third lesson, even in that decade of no returns, okay, on an index basis, you made spectacular money in the right places, whether it was technology. Forget the bubble, even before the bubble.
Yes, Infosys was doing okay.
Infosys was doing okay. You made money in some pharmaceutical stocks. You made a lot of money in all the FMCG stocks.
Correct.
Whether it was ITC, whether it was levers, a whole bunch of these made you a phenomenal amount of money because they were fundamentally good businesses. And they were actually at the receiving end of the license Raj, when they couldn't grow, or they were, hobbled for new licenses, and they couldn't work the system as efficiently as some of our good Indian promoters could. And in a license-free world, they were growing much faster. They suddenly discovered what all this. So there were a lot of opportunities. I mean, all the pharma MNCs made you a ton of money during that time, whether it was Novartis, whether it was Pfizer.
Totally, yes.
So there were opportunities. So the third lesson was that no matter what kind of a market you're in, there will always be some opportunity.
Yes, there will be some sector which will do okay.
Some sector, some ideas, some thoughts which will do well, and you just have to keep looking. Sometimes it won't work. So obviously, even in that 2006 to 2016 period, you had a 2008, you had a 2011 to 2013 recession almost. And you have to go through those periods, and sometimes, even as a portfolio manager, you will make assumptions that don't go right, but that's part of the game.
Great, great, great. So, interesting things about, and a very interesting thing that I find about you is that you started your fund management career, so to speak, in mid 2006 in Ashmore, and 1.5 year later you have 2008 crash, and then even now the category 3 AIF you started in 2017, and 2017 end was the end of the rally, so to speak, at least in the small cap and mid cap. In the broad market, kind of rally ended by 2018 Jan, and we've been in a bear market ever since in the broad market kind of thing. So you start this and this happens, and then you still tide over it. And how does that happen? What does it make you think? I mean, was it the best thing that happened, the worst thing that happened to you, starting a career right at the time when this
Well,
kind of
it's interesting because you never know when is the right time to do it. Okay, so let's come to the first one. When we launched our fund in January 2006, things were good. This was July 2006.
July, yeah.
In July 2006. Things were looking good. Indian economy was doing well. It was a dedicated small cap India oriented strategy. So, it was fun times.
Great.
And 2008 crash was actually not such a big deal because, barring some of these FCCB oriented companies and real estate and infrastructure, as another pocket, I think, it was a flash crash in the sense that it lasted for all of maybe about 9-10 months, a year.
Yeah.
In hindsight of what you and I have seen between 93 and 2003 was a picnic.
Yes.
Right?
Yes.
And even the current down cycle that we've gone through from January 2008 to 18 to now is actually been much harsher and much more difficult than the global financial crisis period.
I
In
agree.
the GFC, the only thing that would have taken you out was leverage.
Yes.
If you had leverage as a manager or as an investor, okay, or if your company had too much of leverage, that is what cleaned you out.
Correct.
Otherwise, nothing cleaned you out. Otherwise, you were fine. A year later, you probably did quite well. And if you recognized that markets were expensive towards the end of 2007 and early 2008, and you took the corrective action on your portfolio in terms of selling out some of the names that are traditionally poor quality businesses, whether it's real estate or construction, and so on and so forth, and made the right bets, you would have come out quite well, which is what
happened,
mercifully happened to us. I think the 2017 March launch was, April launch was also a little delayed because we took some time to file our documents for a variety of reasons. Ideally, we would have done it earlier, 6-7 months earlier, and that does make a big difference to your life returns from the portfolio because the starting point is very important. So I wish we could have done it earlier. But I take 2018, 2019, I think we'll overcome it because, I've seen 2010 to 2013, or rather 2011 to 2013, 2008. More importantly, the big, long drawn out period at the very early of our career. So I think, opportunities come, and these kind of markets give you more opportunities rather than go bull markets. Sometimes it's difficult because investors are upset, and rightly so, because your NAV is down. So it's very hard to put together a narrative which provides hope, especially in April, May this year. I mean, things were very uncertain. I mean, you had a complete lockdown, and you had this virus coursing through the world. You had absolutely no idea what you would end up with, and you went into this crisis on very weak fundamentals. Unlike 2008, 2008, the economy was very strong. The economy was very weak. So it is painful, but I still think that there are opportunities. And last 6 months tell me exactly that history repeats itself. That if you don't lose your nerve, and if you are solvent, in the middle of a crisis, that's the best time to be doing the right things, making the right investments. And, it's worked this time again.
This time too, yes. Yeah, in fact, it is an interesting question that comes up with this kind of thing. In you actually explained the difference between 2008 and this period of time, correct? Because the uncertainty associated with this market and with the economy itself, not just the market but the economy itself, was so high. And in this kind of uncertain times, when you can say that as a fund manager that I know it will, this too will pass and that we will overcome. But how does actually one explain to an investor that when he can see the dissonance between the market going up and the economic growth itself, or the uncertainty about the economic future, how does one explain that you remain with it for the long term, right? I mean, because he keeps wondering कि शायद ये ऊपर गया वापस नीचे आएगा, should I sell, should I get out? Those kind of questions keep coming, and how does one handle that?
So I agree with you, and like I mentioned before, it was a difficult period. It was a difficult period to even put together a convincing narrative, especially on the back of 1.5 years of back-breaking return. When the markets were down and people were nervous, and rightly so. But in the middle of the crisis, we're a long-only fund, right? And investors pay us money to invest it for them. So we can't turn around and say that, look, we're going to sit on 40% cash. And history has always told me that the worst thing that you can do in the middle of a crisis is sit on a lot of cash. You should not have any leverage.
Correct.
But you shouldn't have cash.
Yes. The investor doesn't forgive you for having keeping a position like that.
Opportunity for making back what you lost. Okay, that I think is a serious crime.
Correct.
As a long-only manager. So we said that, look, okay, what do we do? Okay, so we said that, okay, we don't know where this COVID is going. Domestic economy was weak going into the crisis, and it's going to probably be a long drawn out, coming out of it. There is value everywhere. So what do we do? So we said, okay, we're going to do 4 things, and these are time tested. Okay, and nothing that I'm saying is rocket science. 1, let's focus on businesses that have a large exposure to outside India as much to inside India. Because the way the fiscal support came through in the West, in Europe, and in the US told me that maybe those economies will be able to come out before India will come out. So let's have focus on exports. Let's increase our focus to exports as much as we can. Number 2, we said leadership. Okay, and that's something that I've always believed that if there is a business which is a leader in what it does, it could be a small business. It doesn't have to be a large business. Okay, it can be a small business, but it has discovered a niche and it is the most value. It's the market leader in what they have chosen to do.
Correct.
Then they have something that they are good at. They found something, and if that market opportunity is good enough, big enough, then you should stay with it. So let's focus on leadership. Third thing that we said was no debt, which is very obvious, that we don't know where this crisis is going. So we don't like to have debt as a portfolio manager, or we don't borrow for the purpose of investing in the fund, or personally I would never do it. Let's make sure that our companies have very little amount of debt, not zero debt, but they shouldn't be at a stage where if this economic cycle extends to 2 years, the companies go broke. Manageable amount of debt.
Correct.
And last thing that we did was that every business, the product or service it provides, is can be placed on a continuum, which is from an absolute necessity to an absolute discretionary. And we said, let's shift as much towards necessity as we can. Now, obviously, given our value framework, the FMCGs of the world were very, very expensive, and we didn't want to go there. But there were lots of businesses, which are export-oriented businesses, more essential than discretionary, with good balance sheet and free cash flows, which are going a begging. And we managed to, do some of that, reorient the portfolio, and then thankfully, some of those bets have paid off. So that's what has happened. So we said this. I mean, if you look at our April newsletter and March newsletters that we wrote to our investors, we've actually enunciated these things, saying that these are the 4 things we are doing, and this is what we would like to do. Obviously, in the middle of the crisis, when somebody turns around and says, "Oh, we found this mantra," it's very hard to accept, and it's very hard to sell. But it has worked, and
it has worked. Yes.
I'm happy that our performance has come back to some degree, and again and again, again going back to, as you pointed out, the fact that we started in those tough times always teaches you to look for opportunities when in the middle of a crisis. I mean, I always tell my colleagues, I find it harder to invest in bull markets. I find it easier to invest in bear markets.
Yeah, maybe you have a point there, because in the bull markets, probably whether you really don't know whether your choice of the stock was important or whether it was the bull market that is driving it up. When you do something like a purchase of a good stock in a bear market and it does well, then you know that your philosophy and your thought process was the driver for this purchase and the performance of the stock. And I think probably it is easier to, so to speak, shift the wheat from the chaff in a bear market than in a bull market, maybe. And anyway, this is me speaking. I shouldn't be talking about all that. The real question, therefore, is that using all this wide experience that you have, if you were to give any advice to a young investor who intends to start investing in equities himself. And there are several people who say that I will put little money to मेरा पैसा डालना ही है market में. I want to do that, and whether there's mutual funds or PMS or AIFs, I will do a little bit on my own. And then what would be the advice which would help him at least not make bad losses? I mean, so the hygiene factors that he should really look for.
Yeah. So a couple of things. One is, investing requires a lot of work.
Okay, so it's not a tukka, really.
It's not a picnic. It's not something you can do in 15-20 minutes every evening, or read. In our old days we used to get that bhav copy, and I still say that bhav copy पढ़ के आप invest कर लोगे, ऐसा नहीं होता. So you have to do a lot of work. You have to be prepared to read annual reports. And there's a lot of information that's available today. When we started out, nothing was available. Getting hold of annual reports was difficult. Forget anything else. So you have to do the homework. So my first piece of advice to young investors is that if they want to buy and sell stocks on their own, they have to be prepared to do a lot of work. Read up about the company, read up about the business, read up about the management and their track record. Familiarize yourself so much that you can actually identify with the company and its business and its competitors as you walk around in the marketplace and you see products and services which either are being offered by your investee company or by its competitors. So you have a mental map of what you're dealing with. And that's hard work. So don't invest unless you're willing to put in the work. That's number one. Number two, if you're early in the stage of the cycle, there are two things that can happen, and that depends upon the amount of risk appetite you have. See, all of us are built differently. All of us have a different risk appetite, and it's very important to recognize who you are as an individual and what your risk appetite is. And let me explain this in a little bit of detail. If when you're 25 or 26 and you just come out of your business school or your college or whatever it is, and you are in a well-paid job which has 25, 30, 40 years of service ahead of you, you can actually afford to take a lot of risk. You can afford to hit every ball that comes your way, because you can afford to lose wickets. You got a long innings ahead of you, right? And so this is the time when you can afford to take a lot of risk. But do you have the stomach for the risk or not, is something that every individual has to analyze. And that is something that every individual will come up with a different answer. Okay, I realized this very early in my in my life. You know, my wife and I have very different risk temperaments. So, you know, every year when she would get a little bonus, 20, 30,000 rupees, she'd say, okay, tell me what I should do with it. And I would always buy, the perpetual growth stories for her, like HDFC Bank or whatever. And I would do all the, funny stuff. Okay. And this is PA investing we're talking about.
Correct.
I was in the sell side. I'm talking about late 90s and so on. Okay. Because I realized that for her, it's very important that she doesn't lose serious money on any of her holdings.
Correct.
That's who she is.
Correct.
And I don't mind. And I would personally, do a lot of risky stuff in hindsight. Probably also had, loans against shares, because back then you were young and you felt brave and you said that, okay, TK, even if I have a 20 lakh leverage, and 20 lakhs was a big amount in the 90s.
Those days, yeah.
Those days, TK, even if I blow it up, I'll earn it back. I've got 20 years of service.
Yes, absolutely.
So that recognition for the investor is the second step, because your investment strategy will be a function of your risk appetite.
Correct. So what you're saying is that your investment strategy should actually be in sync with what you are as a person. Yeah.
Who you are as a person. So if you are a risk taker and you have the ability and the capacity, and recognize those numbers well, because you shouldn't end up losing an amount you can't afford to make up.
Correct.
You should go back to your parents and ask to fill up that hole that you've dug. I mean, that's silly, right? So you should understand who you are and understand what your financial capacity is. That's step 2. Step 3, then you look for investment opportunities. I mean, if you are fortunate that you have some money to lose, or you can afford to lose some money, and you have a big risk appetite, then you can afford to, play around with options, do some funky stuff, look for, ideas which can be multi-bagger, but come with their share of risk. If you're early, but you want to save that money that you've saved, because it's a hard-earned money, it's the first bit of savings that you have, then you buy the good quality, market-leading growth stocks, which in my view are like buying gold. Okay, what happens when you buy gold, right? The worst that can happen to you is that 7 years later you'll get back your principal. That's the worst that can happen to you. Usse bura nahi hoga.
Correct.
I mean, and the good part is that you might make some money along the way, or you might lose some money along the way, but it's not a game changer. So if you buy, an overvalued but a very, very solid business,
yes.
What is the worst that can happen? The worst that can happen to you is that you won't make money over a 7-year time period. I mean, levers didn't make any money for us between 2000 and 2007.
Correct. Nobody realizes that, right? But everybody thinks levers, so like a fixed deposit type of return comes regularly.
It's a gold. It's not a fixed deposit. It's like gold.
Gold,
It's gold. Paisa nahi banega. Okay, and you'll be happy that you can sell it at any point you like. It will be around. It's not going to blow up. It's one of the best businesses in this country. ठीक है, तुम सोना खरीद रहे हो. Be aware that gold can go through long periods of making no money for you.
Making no money, yes.
And you should be okay with that. So I think that's the advice I would give people, that be prepared to do the work, understand who you are, understand your resources, and then decide what you want to do.
Okay. So some quantitative factors that you could throw in, because I think what people would like to hear is you say things like, ye to nahi karna hai. I mean, if debt is very high, don't buy. Something like that. Is there something like that you have in mind, which says that this is a way of eliminating the stocks?
Yeah. There's a long list. Some of them have come with tuition fees. Some of them have come with because somebody else has paid the tuition fees, and I've observed it being.
So people who listen to this would be the guys who would have found that you have paid the tuition fees and they're getting it for free.
Correct. There's a long list. Okay, it's really a very long list. So some of the basic things are that, if there is a business which is surviving because the government has propped it up, or it has a monopoly which is not sustainable in the long run, or it is a franchise which is very poorly run, but it is surviving because nobody else has been able to step in for XYZ reason, don't go near it.
Okay.
If it's a business which has a large government interface, be very careful, because typically, when you're dealing with the government, either you don't get paid on time or you don't get paid at all, or you get paid very low value for what you provide, which forces you to deliver subpar, quality, and sooner than later, that's a recipe for disaster, because then you will build an organization that cannot work on quality. No organization, in my view, can sell a poor quality product to one buyer and sell a high quality product to another buyer. It doesn't happen. Okay,
Yeah.
you become a company that makes shitty products.
Correct.
Okay, so I try and avoid businesses like that. Look at the track record of the promoter. Has he been somebody who's held in high esteem by his peer set, by suppliers, by bankers? Who banks for this guy? Typically, you get a sense of what kind of people are you dealing with. So I'm saying that try and invest in businesses where the promoter has a strong track record of having done the right thing in the past. Okay, and that, I think, is an important attribute. In terms of financials, there are 3-4 formulas we use. Okay, the first is we pay a lot of attention to net operating cash after working capital changes.
Correct.
Okay, so this is PAT. Okay, and I don't do PBT plus, then deduct from it the cash tax paid. No, I don't do that. I take PAT because taxes which have not been paid but accrued is a future liability, and it's best to exclude it. Okay, so you take PAT, you add back depreciation, you take out, working capital changes, and the number that you are left behind is
Yes.
the real cash that your business has generated.
Yes.
Okay, and this cash should be enough to support your growth and leave something behind to pay out as dividends. Okay. Now, if there is a business which through its history has never generated that as a positive number,
Yeah.
then it may be an ultra hyper growth business, which, a lot of tech companies and startups are like that, and there's nothing wrong with that. But then you have to recognize what that business is and why is it like that. If it is a mature business and it has continuously traded like that, then you are in a mug's game. Because if a promoter is running that business and continuously running that business, then it's very apparent that he's doing it for some other reason. He's not doing it because the business makes money. Maybe the business makes money for him, but it doesn't make money for you as a minority.
Correct.
Right? So that's one very important metric. The second thing that I've learned is that leverage should be limited. So one of the formulas through trials and errors and various other tribulations, I would say, we've said is that there's a thin line in the sand, which is 3 times debt to EBITDA. Okay, and we don't look at forward numbers. Huh? This is
historical numbers. Yes, correct.
Because historical is reality, future nobody knows.
Correct. Correct.
So historical debt to EBITDA should be less than 3x. Okay, why 3x? Because our experience is that is a number which will allow a business to survive even if things go wrong for up to 2 years. क्योंकि 2 साल के बाद तो क्या होगा किसी को नहीं मालूम. But at least in a foreseeable 2-year period, if the business metrics are still bad, a business like that, your debt to EBITDA might climb to 4x or 4.2x, but you won't go under. Correct. But somebody who's at 4 or 5 or 6 will go bankrupt.
Yeah.
Okay, so either the debt will need to be reorganized or the equity will need to be reorganized, and you as a minority equity holder in both cases will be the loser.
Yes. Yeah.
So there's no point in this. So that's a second thing that we don't do. And the third thing, which is a very obvious one, which everybody talks about these days, is that ROC should be respectable. It should be higher than cost of capital, which is a very obvious one, and which should be anyway a very, very early filter, in any business model. Correct. So those are the things that we look at.
So I think it has been an incredible talk, really. I mean, I have learned, to be honest, and I'm not saying it just for effect, I have actually learned a bit more about this whole process of investing just by listening to you today. So finally, before we end up maybe, and before I ask you whether you have something else to say, one of the things that I would like to know more is what is it that makes Ashwini Agarwal tick as a person? I mean, any particular things that you do, anything that you would like to share, any daily routine that you follow, things like that.
So, there are a lot of things, small things that one does that keeps you sane in these maddening times. I love what I do,
Yeah, which
and
is
capital markets. And I tell young people when I used to hire them at Kotak or UBS, one of the funny things is that when you and I joined this business, there was no money and there was no glamour in it.
correct. It was not a business actually. It was, I mean, it was a mom and pop kind of show at one time, long back.
And
And
people used to, in some weird way, look down on this business,
yes,
if you remember.
uh,
It
I
wasn't
didn't.
the easy thing to do at all.
करेक्ट इट वाज लाइक ही एक ब्रोकिंग में चला गया इसका तो बुरा होता है आई मीन आपका इंजीनियरिंग
Right.
एमबीए व्हाई डज इट डू दैट
So, but in the last 10, 15 years, 20 years, things have changed. So when young people come in
या
and they join, one thing that I ask them and I tell them and I try and assess all three are that do they have a genuine interest in this business? In prices going up and prices going down and all the fun that comes with it. Because if they don't, then you will be a cog in the wheel and you'll never really, enjoy it. So I've always enjoyed it. Okay.
करेक्ट
And that's the biggest driver, that you go up every morning, get to work and try and figure out, ki, boss, acha, ab kya hoga? How do we do things and how do we change things? But I think over time, I've realized that what keeps you in the game is an ability to detach yourself and not let the profit or the loss or the gains or the declines affect you too much, because the only thing that you can do is be calm and collected, because that is what will allow you to take the right decisions. Because fear and greed, I mean, every book says that, are the biggest enemies of investment, of making investments or of being in the business of investment. And I'm being very honest. I mean, it affects all of us.
yes
You see something running and you try and see why you don't own it, and then you try and wonder that if you should or you shouldn't, and all this nonsense happens all the time. When
करेक्ट
something's falling that you own, you wonder that if you got it all wrong, and you try and sort of reassess and so on and so forth. And while that review process, etc., is all part of the game, there has to be a certain detachment, that you need to be able to accept that what goes up will come down, or what goes down will come up, and so on and so forth. And that detachment, I have personally gained a lot through meditation. So I attended, a Vipassana course early in 2019. Spent that mandatory 10 days 10 days in silence and so on. And I practice meditation every morning,
ओके
half an hour, 45 minutes, not the 1 hour in the morning and 1 hour in the evening that is advised by the Vipassana folk, because I just find it too much.
that's
Half an hour to 45 minutes I do every day. And in the evening before I sleep, I read fiction. Okay.
okay
For half an hour, 45 minutes. I mean, nothing to do with the markets, nothing to do with deep thinking, non-fiction, barring history. I love history. So
okay
I'll either read something that has to do with history, or I will read some fiction. And I find that, it allows me to kind of switch off. I think it's important to switch off, because it refreshes you and prepares you for the next day in a very, holistic manner. So those are the things that I'd like to share. That don't get too swayed by either your losses or your successes.
yeah
So because I believe, I may be wrong, but I believe that the process of investing always has a little bit of luck attached to it.
correct it has
Uh,
yeah
and you can do all the arithmetic you want, and you could get the stock right or you could get the stock wrong, because uh, you can only analyze what is in the present. The future is always uncertain.
correct
And that to me is a lesson that I tell that to myself, and I keep telling that to my colleagues. And I would love it if people, also can follow it. That don't let your wins go to your head, and don't let your losses pull you down. I mean, this is all part of life. Here today, it's there tomorrow. It doesn't matter.
So what I hear really is that what you're saying really is that you have only control over your process, not on the outcome of the process. One, and two, be equanimous to both success and failures. This is really what you, and it's a brilliant message to give to anybody who's watching this program. I think because that's the key thing that people need to understand if they have to be in it for the long term. For the short term, you can come in and go, but once you get this,
survive the race.
Yeah, it is very important. Thank you so much for what you have done. You've given me more than an hour of your time, and you have answered all the questions very candidly, and you have been most forthcoming. And I think it's an incredible experience for me to conduct this conversation with you. Do you have anything else that you would like to say? I think you've said most of it, but I still need to ask you.
No, I think I worked for Mr. Uday Kotak for 4 years. He's of course an icon that everybody knows.
Truly.
And one of the things that he would often say, and I always sort of believed in it, but it got reinforced for the 4 years that I worked for him, and I've carried it with me since then, is whenever you do something, you should be convinced that you're doing the right thing. Okay. So long as you follow that, the rest of it, will fall into place or will take care of itself. Just don't do anything that is the wrong thing to do, and do it knowingly. Just don't do that.
Yeah, a perfect takeaway from this conversation. I think it has been. Once again, I have to say it has been incredible, and thank you so much, Ashwini.
Thank you, Mahek. Thank you for having me here.
You are welcome, and hopefully we will keep in touch, and maybe if we get an opportunity once again in the future, we will do this with updated ideas of what you are thinking of at that point in time. Thank you so much, and we'll see each other soon. Thanks.
Take care. Have a nice day. Bye-bye.
So as usual with these conversations, I try to highlight the takeaways that I had from them. And this was indeed an extremely interesting conversation. So I have a series of takeaways. So first thing that I got from this conversation was that Mr. Agarwal says that there are two types of investments that are the best investments that you can do. The first is a good business that are at a very, very early stage in their cycle. And the example he gave was of Page Industries in 2008, when he realized that jockey typically gives their licenses for a 10-year period, but most companies that they have given these licenses to in the past have remained with them for a long time, and therefore that one fear that Page Industries will lose their license was not there, and he therefore decided to go ahead and buy that company. The other example he gives is of a good business that are going through a temporary problem. So it is of course important that you need to actually assess the problem and say that okay, this is a temporary problem. And the example he gives is that of Balkrishna Industries, which had issued FCCB in the 2006-2000 period, and most of the companies which gave these FCCBs were finding it difficult to repay it back when the prices fell. But they were able to, Mr. Agarwal and his team was able to actually understand, or at least had an expectation that Balkrishna will be able to pay it back because the amount was not that big, and the indiscriminate selling that happened in Balkrishna Industries along with the rest of the companies which had FCCB issues allowed them to buy Balkrishna, and when Balkrishna actually repaid the FCCB, the stock started going up and they made good money on that. Another example he gives is that of ITC in 94-95, when they had a large excise duty dispute with the government, and if you could take the call that this dispute will get settled one way or the other, then you could have made good money, because finally when ITC just decided one day to pay off the entire money that they owed the government, the stock shot through the roof. Then Mr. Agarwal says that he's a value investor, but he follows a value investment philosophy. But value for him is not just about low PE and low PB. A good franchise, a company that is entering an industry which can have a long and sustainable growth and is challenging the incumbent is also great value. And the example he gives that is that of HDFC Bank, which he learned the hard way, because when the IPO happened and HDFC Bank was trading at 30, he came out with a note on HDFC Bank and put a hold on it. So this is the lesson he learned, that a long-term growth stock can be a value based on its good franchise itself. Then there is a very good thing that learning that I got from this conversation, and that is that in bad times adapt. For example, in March 2020, Mr. Agarwal says that they decided to focus on companies that focuses on exports, and the reason he gave was that the fiscal stimulus from countries outside of India were much more than that in India, and therefore any company which had a larger mix of exports in its sales would do better, because the economy there outside India might not contract as much as the economy in India. So they focused on exports. They also focused on companies that have leadership in their sector, and he said that that is because if a company is a leader in its sector, then that company must be doing something right. Then they focused on companies that have low debt, and they have focused on companies whose products are more of a necessity than discretionary sales. So basically, any company whose products are definitely needed by the customer was a company that they focused on, and that has helped them to actually weather this storm, the COVID storm, that we all faced. Then I had asked him a question as to what advice he would give to investors who want to actually invest on their own. And the first thing he said was, know yourself first and your risk appetite, and then accordingly invest in companies, which meant that he gives this example of his wife who had a lower risk appetite and didn't want to lose her hard-earned money, and he would then invest her money in a company like, say, HDFC Bank, whereas he himself was willing to take far more risk because he knew that his risk appetite was far larger than hers. So this is something that comes out very strongly in his advice to investors. So when I asked him for some quantitative factors that any investor who invests on his own should look out for, some kind of hygiene factors which he should take care when he invests in companies, he gave me three numbers. And first was that the net operating cash flow after adjusting for working capital changes should be positive. According to him, if a company has been net operating cash flow negative for a long period of time, then there is a major question to be asked, and which is that why is the business promoter then running that company? Typically it would mean that the minority shareholder might not really make too much money in a company like that. He says exceptions are there like startups, etc. But otherwise, in general, this is a rule that he would like to follow. The second thing was that the debt to historical EBITDA should be less than 3. This, he says, is like a line in the sand for him, and any company which doesn't have that typically could get into trouble in case the business doesn't do well for a couple of years. So he likes to have companies in his portfolio which have this kind of numbers. And the third was that the ROCE, that is the return on capital employed, should be greater than the cost of capital for the company. There was also a final takeaway that I had from this talk, and it is that you have control over your process and not over the outcome, which is an incredible thing. So everything is about the process. So you work hard to ensure that your process is okay, and then you invest. But that doesn't necessarily ensure that the outcome will be good. So therefore, he says, become equanimous about both success and failure. You have only control over the process, not over your outcome. So become equanimous about both success and failure. And final takeaway, again very important, was that he tells me that Uday Kotak told him during his tenure there that whenever you do something, you should be convinced that it is the right thing to do. Don't do anything that you yourself know to be wrong. And this is an incredible takeaway to have at the end of this long conversation for me. So my viewers, I request you to again pause and see whether you can subscribe to this video. Do put in your comments, and if you have any questions, do ask those questions in the comments below. We will see whether we can get Ashwini Agarwal to answer to those questions. Thank you, and we'll see you soon again.